You've turned the ship around. Why?
Well, basically, when we were last here, I suggested that the blue chips should make new highs, but the broad market should not make new highs. And that's exactly what happened. The S&P made a new high Friday, Monday. The Russell 2000 did not. More importantly, contrary to what most people think, Japan did not make a new high this month. If you adjust the Japanese market to the U.S. dollar, don't look at it in Japanese yen terms, but look at the Japanese market in U.S. dollar terms. Its peak was May 23, 2013 on an intraday basis. On a closing basis, its peak was last year on December 31st. So the easing they're doing in Japan, the Abenomics as they call it, really isn't helping the real stock market or helping the real economy. They're in a recession. So I think the underlying economic trend is negative, and the stock market is giving the classic signs of a top at this point.
Because we're not seeing higher highs.
Not seeing higher highs in the broad market. The blue chips are going to be making new highs, which they have, but the broad market is not, and the rest of the market, the SP itself, should follow the broad market ultimately.
Okay, so short, if people believe you, you know, how do they express that view? How do you express your view?
Well, we always maintain flexibility. We are now 100% short stocks. We got short on Friday. And our Friday was a very fascinating day technically.
Not flat, short.
Short, because we go long into Friday, got short into Friday. Friday closed with a TRIN. People may know what a TRIN is, but TRIN measures the capitulation to the upside. And TRIN was at 53, the third lowest reading of the year. But it was the first time you saw a trend below at 53, but the market at a new high, which means people said, I got to get in, I got to get in. And the reason for that was the news out of China. And my feeling is the news of China doesn't really affect the United States. Markets are still, economies are still very...
Why? It's the second largest economy.
Yeah, but I don't think it's going to help China either, actually. It won't help China, it won't help the United States. Playing around with money, playing around with the money supply, doesn't really help the real economy. It's people working in the fields, people working in the factories, people getting jobs. Tinkering with money does not give people personal jobs.
So do you agree with Jim Chanos that the data we get out of China supplied by the Chinese government is just fictional?
Well, Chanos is a fundamentalist. Maybe he's right about the being fictional. The markets are telling me something's wrong with China. China hasn't made a new high in 4 years.
But you're, at your heart, in your heart of hearts, Milton, you're a fundamentalist too.
Well, there's a CFA program, Chartered Financial Analyst. I'm number 6,881st CFA. There are now hundreds of thousands throughout the world. So I'm one of the original fundamentalists, actually. But I found as a fundamentalist alone, you don't have an edge because you're competing with hundreds of thousands of other people who look at the same data you're looking at.
That's why active managers underperform benchmarks on a regular basis.
Exactly. You have to have some sort of an edge, and my edge is using the technicals as well.
Which is why we're talking about all this technical in some...
Exactly.
You know, in some people's minds, mumbo-jumbo, right?
Talk about mumbo-jumbo. It's funny, I speak to fundamentalists, and they say the market's going up in December because oil goes up in December. That's superstition. That's not fundamental analysis.
That is definitely not fundamental analysis.
That's a good point. That is a good
telling that
point.
to you. Another fact I hear from the fundamentalists, 2015 will be a great year because since 1905, the Dow never had a down year on a year ending in a 5, and the average gain was 36%. But I'm hearing this from...
This is newsletter nonsense, right?
Exactly, but I'm a technician, but I don't follow superstition.
I should hope not.
Right.
So is the easiest thing to do just to buy a negative S&P 500 ETF? Is that what you would do?
At this point, you want to buy a negative ETF or short or a positive ETF. And, you have to be flexible. Things may change. At this point, it looks like the next move will be down.
But you think it's important to be tactical, which is why you've switched from being a bear to a bull and back to a bear again.
Yes, exactly.
Is the market liquid enough to be so tactical?
Well, not for everybody. You see, most people are not going to do these kind of things. Even some of my clients resist my recommendations. Most people can't be flexible enough to get in and out and long and short. People want to have a view, a 5-year view, and follow that 5-year view for 5 years. But the reality is, over 5 years, there's been many changes in the markets, and you have to have the flexibility and the ability to change.
So I know that you also happen to be long gold producers.
Right.
So you're short everything that isn't gold, but you're long gold producers.
Right.
Why?
Well, I once managed one of the largest gold funds back in the late 1980s, and I found that gold is strictly a commodity. People put magic to gold. They think there's some greatness about gold. Gold moves like commodity moves, and the bear market in gold started in 2011, and it was washed out. But I was ready to buy gold stocks over the last year or so, but I had to wait for some technical evidence, and we finally got the technical evidence about 3 weeks ago, and we actually bought on the day of the low.
Okay, and you think that the rally in gold is going to continue, and that so if we look at the relationship between gold producers and the gold price, there has been negative leverage in the gold producers because they have dropped much more than the gold prices drop.
Well,
you think that we'll see the same thing on the way back up?
I think we saw a secular top in commodities in 2011. There was a 10-year bull market in commodities. They gained 12% per annum on average. Now we're in a secular downtrend in commodities. I think this is a counter-trend rally in gold. Could go up 20, 30%. But I don't think the deflationary aspect of the commodity market is over. I think we're in early stages of deflation. It's a secular downtrend in commodities. That's why oil is going down. Oil made a double top April 2011 to September 2014. And now the drop in oil is just a natural drop in a...
I mean, oil is down again today.
It's just a natural drop.
WTI is trading at $73.
Nothing strange about this drop in oil. When you have a commodity bear market, oil is going to go down. It just held up for 3 years.
If there was only one trade I could put on today, and I said, Milton, tell me, what should it be?
For you?
Yes.
Cash.
If you were to say,
Milton,
you're
she's just going to spend it.
Yes, I'm just going to spend it. All that Black Friday, etc.
Well,
one trade.
On a long-term basis, you'll probably be able to buy stocks at significantly lower prices 2 or 3 years from now. So I'd be short the stock market. You'll probably be able to buy stocks significantly lower 2 to 3 years from now.
2 to 3 years from now.
Right. So if you want to take a long-term view, you short stocks now and you'll buy it 20, 30, 40% lower sometime in the future. Shorting
stocks now is going to be outrageously painful if you think about where the market's going to be in the next 2-3 months, though.
Not necessarily. Again, superstition again. Why will it be up for the next 2-3 months? On what basis is there? The fact is, the Russell 2000 is the most overvalued it's been in history. The value line, which measures...
On what basis?
On basis of strictly price-earnings ratios. The value line median price appreciation potential of their universe of stocks is at 35%, one of the highest valuations in history. Dividend yields are one of the lowest levels in history. There's no reason to assume stocks are going to do well. And QE has ended. The most important thing, we have 7 distinct tightening moves by our Fed. Each time they reduce the QE, that's a tightening move. 7 tightening moves by the Fed. Generally, after 7 tightening moves, the market doesn't go much higher.